Introduction: Why index funds still rule in 2025. Index funds have become the foundation of modern investing. Simple, low cost, and historically reliable. In a world where stock picking and market timing continue to frustrate even professionals, index funds offer a disciplined way to build wealth. They track market indexes like the S&P 500, Nasdaq 100, or Russell 2000, giving investors instant diversification and market-level returns, all while charging minimal fees. In October 2025, several index funds continue to shine for their low expense ratios, strong long-term returns, and ease of access. Let's break down the best options and how to use them effectively in your portfolio. Navigation. Section 1. Understanding index funds. Bowser. What is an index fund? An index fund is a type of mutual fund or ETF that aims to mirror the performance of a specific market index, like the S&P 500 or Nasdaq 100, instead of trying to beat it. Mutual funds buy and hold for the long term. Prices update once daily. ETFs, exchange-traded funds, trade like stocks throughout the day. Bowser. Why they matter. Diversification. One purchase gives you exposure to hundreds of companies. Low fees. No manager means no hefty management cost. Predictable strategy. They follow market performance, not human emotion. Strong long-term returns. Historically, major indexes have returned around 10% annually. Navigation. Section 2. The best S&P 500 index funds for 2025. The S&P 500 represents the 500 largest U.S. companies, the heart of the American economy. Here are the top options this year. 1. Fidelity Zero Large Cap Index, FNILX. Expense ratio, 0%. 5-year annualized return, 16.3%. Overview. Part of Fidelity's Zero lineup with no expense ratio, a revolutionary offering. Tracks the Fidelity U.S. Large Cap Index, which closely mirrors the S&P 500. No licensing fees make it unbeatable in cost. Best 4. Investors seeking a no-fee, long-term core fund for wealth building. How to buy. Directly through Fidelity or any major broker. Checkpoint. If your goal is long-term compounding with minimal fees, FNILX is one of the best starting points. 2. Vanguard S&P 500 ETF, VOO. Expense ratio, 0.03%. 5-year annualized return, 16.5%. Overview. One of the largest and most trusted ETFs globally. Vanguard's investor-first philosophy ensures low costs and transparency. Best 4. Anyone looking for a tried-and-true ETF for long-term portfolios. How to buy. Available via Vanguard or any online broker. Practical use. Use VOO in tax-advantaged accounts like IRAs or 401ks to grow wealth tax-deferred. 3. Speeder S&P 500 ETF Trust, SPDR. Expense ratio, 0.095%, 5-year annualized return, 16.5%. Overview. The original ETF, launched in 1993. Massive liquidity, perfect for traders and institutions. Tracks the exact S&P 500 index. Best 4. Investors who want highly liquid ETF for active or passive use. Checkpoint. SPY is ideal if you want fast execution or intraday trading flexibility. 4. iShares Core S&P 500 ETF, IVV. Expense ratio, 0.03%. 5-year annualized return, 16.5%. Overview. Managed by BlackRock, the world's largest asset manager. One of the top 3 ETFs in the world by total assets. Best 4. Buy and hold investors who value liquidity, longevity, and low cost. 5. Schwab S&P 500 Index Fund, SWPPX. Expense ratio, 0.02%. 5-year annualized return, 16.5%. Overview. Sponsored by Charles Schwab, known for investor-friendly pricing. A classic mutual fund with a long record since 1997. Best 4. Investors who prefer mutual funds over ETFs and want to minimize expenses. How to buy. Through Schwab.com or partner brokers. Section 3. The best Nasdaq index funds. The Nasdaq 100 is technology-heavy, packed with innovation giants like Apple, Microsoft, and NVIDIA. It's more volatile than the S&P 500, but has delivered superior growth in recent years. 1. Shelton Nasdaq 100 Direct NASXD. Expense ratio, 0.51%. 5-year annualized return, 17.3%. Overview. Tracks 100 of the largest non-financial companies on the Nasdaq. A great play for growth investors seeking tech exposure. Best 4. Long-term investors comfortable with higher volatility for higher potential returns. Practical use. Combine NASXD with a stable S&P 500 fund to balance growth and stability. 2. Invesco QQQ Trust ETF, QQQ. Expense ratio, 0.20%, 5-year annualized return, 17.5%. Overview. The benchmark ETF for the Nasdaq 100 consistently ranks among the top-performing large-cap growth funds, managed by Invesco. Best 4. Investors want exposure to the biggest names in tech, like Amazon, Meta, and NVIDIA. Checkpoint. QQQ is perfect for those who believe in long-term U.S. tech dominance. Navigation. Section 4. More top index funds beyond S&P and Nasdaq. For better diversification, investors can explore funds tracking smaller companies, the entire U.S. market, or blue-chip portfolios. 1. Vanguard Russell 2000 ETF, VTW. Expense ratio, 0.07%, 5-year annualized return, 11.6%. Overview. Tracks 2,000 small-cap companies, the growth engine of the U.S. economy. Offers strong long-term potential and diversification. Best 4. Investors seeking small-cap exposure for growth over decades. 2. Vanguard Total Stock Market ETF, VTI. Expense ratio, 0.03%, 5-year annualized return, 15.8%. Overview. Covers the entire U.S. stock market, large, mid, and small caps. Essentially one-stop exposure to the American economy. Best 4. Anyone wanting a set-and-forget portfolio anchor. Practical tip. If you could only pick one fund for life, VTI is one of the smartest options. 3. Speeder Dow Jones Industrial Average ETF Trust, SPDY. Expense ratio, 0.16%, 5-year annualized return, 13%. Overview. Tracks the 30 blue-chip companies of the Dow Jones Industrial Average, focused on mature, dividend-paying giants. Best 4. Investors prioritize stability and dividend income.
Money sign. Section 5. Why index funds dominate portfolios. 1. Attractive long-term returns. The S&P 500 has returned around 10% annually over the long run. Compounding over time is what creates true wealth. 2. Instant diversification. A single share of an S&P 500 fund provides exposure to 500 companies. Reduces individual stock risk and volatility. 3. Lower costs equal higher returns. Average index funds cost between 0.02 and 0.10% compared to 0.42% for actively managed funds. Every 0.1% saved annually adds thousands over decades. 4. Lower risk profile. Because they're diversified, index funds are safer than betting on a few individual stocks. Checkpoint. Over 90% of actively managed funds fail to beat the S&P 500 over 10 years. That's why index investing wins. Puzzle. Section 6. How to invest in index funds step by step. 1. Research and analyze. Before buying, understand. Geography. U.S., global, or emerging markets. Sector. Tech, healthcare, or total market. Market cap. Large, mid, or small companies. Investment goal. Growth, dividends, or stability. Example. If you're 30 with a long time horizon, combine VOO, core U.S. exposure, plus QQQ, growth, plus VTWO, small cap exposure. 2. Compare fund details. Expense ratios. Lower is better. Taxes. ETFs are more tax efficient than mutual funds. Minimums. Mutual funds may require $1,000 to $3,000 to start. ETFs often allowed fractional shares. Liquidity. ETFs trade anytime. Mutual funds trade once daily. 3. Purchase your fund. Buy directly through fund websites, Vanguard, Schwab, Fidelity, online brokers, Robinhood, Charles Schwab, Fidelity, or E-Trade, robo-advisors, Betterment, Wealthfront, or Schwab Intelligent Portfolios. Pro tip. Set up automatic monthly contributions to practice dollar cost averaging. Weight. Section 7. Key factors to consider. 1. Long-run performance. Always check the 10-year history and consistency across market cycles. 2. Expense ratio. Even small differences matter. Example, 0.05% equals $5 per $10,000 per year. 0.20% equals $20 per $10,000 per year. This compounds into thousands over decades. 3. Fund availability and convenience. Some mutual funds are restricted by broker, however, ETFs are universal. 4. Trading costs. Most brokers offer commission-free ETF trades, but check for load fees on mutual funds. Warning. Section 8. Understanding the risks. 1. Market risk. Index funds move with the market. They can decline in bear markets. 2. Sector concentration. Nasdaq-based funds are tech-heavy. Diversification is key. 3. Underperformance risk. Certain indexes, like small caps, may lag for years. 4. Currency and inflation risk. For international index funds, FX fluctuations can impact returns. Checkpoint. Index funds rarely go to zero, but patience and a long-term horizon are essential to ride out downturns. $. Section 9. Index fund fees explained. Mutual funds may charge 1. Sales load, a one-time commission, avoidable. 2. Expense ratio, ongoing management cost. ETFs charge only an expense ratio, a tiny daily deduction. No sales load, no minimums, more flexibility. Average 2023 costs. Stock Index Mutual Fund, 0.05%. Stock Index ETF, 0.15%. Average Active Stock Fund, 0.42%. The difference between 0.05% and 0.15% may seem small, but over decades it's huge. Clock. Section 10. Is now a good time to buy? Yes, if you're investing for the long term. Markets have hit new highs, but history shows investing at highs still leads to strong long-term gains. Time in the market, DIT versus timing the market. Use dollar cost averaging. Invest a fixed amount regularly to smooth out volatility. Brain. Long-term rule. The best time to invest was yesterday. The next best time is today. Puzzle. Section 11. Building a sample portfolio. Practical use. Core U.S. exposure. Vanguard S&P 500. VOO. 50% low-cost stable growth. Tech and innovation. Invesco QQQ. 20% high-growth innovation exposure. Small cap growth. Vanguard Russell 2000. VTWO. 15% long-term compounding. Blue chip income. SPDR Dow ETF. DIA. 10% dividend stability. Cash reserve. Money market or bond index fund. 5% liquidity and balance. Checkpoint. Rebalance annually and keep adding regularly. Consistency beats perfection. Puzzle. Section 12. Final thoughts. The power of simplicity. The beauty of index investing lies in its simplicity. You don't need to predict winners. You don't need to time markets. You just need to stay invested and keep costs low. Even legendary investors like Warren Buffett recommend index funds for most people. His advice to his heirs? Put 90% of the money in a low-cost S&P 500 index fund and 10% in short-term government bonds. Coin. Key takeaways. A. Start with broad funds like VOO, IVV, or VTI. B. Add growth with QQQ or NASDX. C. Balance with small caps like VTWO. D. Avoid high-fee funds. Expenses erode compounding. E. Stay consistent. Time is your biggest ally. Comment bubble. Practical reminder. Wealth isn't built in days, it's built in decades. Start small, automate your investments, and let compounding do the heavy lifting.